Don't talk to me, talk to him.
Well,
I'm sure the senator knows this argument well.
I've spoken up on behalf of the Fed retaining a robust regulatory presence, Steve. I think it's important to getting the monetary policy right. I also think anybody else is going to have to work their way up the information curve. The Fed made some mistakes. I think they learned from the mistakes. So, Jim, I'm all for you guys keeping your finger on the pulse of the economy. Well, let me ask you, though, what would you learn from the community banks you can't get by retaining your regulatory role over the big ones?
The big banks are these big global enterprises. They, they're in the middle of big deals that are putting together huge companies and things like this. The small banks are really lending to small businesses, the job creators in the economy. It seems to me you'd want to know a lot about that if you want to make good monetary policy.
The Fed can't get that information at this point?
I think you lose touch. You definitely lose touch. I mean, maybe you can find other ways to get the information, but I think you'd lose touch with Main Street America.
So you're saying it's qualitatively different data you get from the small banks than the large ones?
It means that you're in the bank.
In terms of informing your monetary policy decisions?
I think so. I think it means that you're in the bank. You understand what kind of problems they're facing, what their loan demand really is. You're understanding what they're really facing on the ground. And I think it's a very different thing than to go into Goldman Sachs and start talking about, well, maybe we'll do this. I don't know, they were advising the Greek government. Or
very wise man you have with us here this morning. He got his PhD from Indiana University.
You got to love it.
Certainly works for me.
President Bullard, you talk about the oversight that you've had in the past, and Senator Bayh pointed out that he's very much in favor of you keeping those oversight powers, but there were some mistakes that were made. What happened, and where did the regulators, not only at the Fed, but at other places in Washington, fall down in terms of seeing things like Repo 105, in terms of seeing some of these problems and the big leverage that was taking place?
Mistakes were made, but not on the small bank regulation. That part has worked, fairly well. Even though that that's under stress right now, that has worked fairly well. For the very large organizations, frankly, the Fed didn't have any regulatory authority over Lehman or Bear Stearns or any of the investment banks. None of the big insurance companies, Prudential, AIG, and none of these financial hybrid type companies like GE Capital. What you've got to get going forward is you've got to get the central bank to have this complete view of the whole financial landscape. They have to understand everything that's going on, because what has happened over time, we used to have a banking system, but this shadow banking system has grown and grown and grown, and that's where most of the problematic institutions were. Those weren't under Fed guidance during this thing. So we did not have a team sitting in Bear Stearns telling us, okay, here's what Bear Stearns is really facing. Here's what's really going on at Bear Stearns. We did not have that. So we're sitting there as outsiders, and then we have to make a decision in 24 hours about what to do about that.
That's an argument for even broader.
Yes, and that's where we should be going. And some of the provisions of the bill are going in that direction.
I can remember when Trichet said, it's much easier over here because all we have to worry about is price stability. Remember when he said that? We only have one role for the Fed. Can you tell me all of the varied and sundry roles for the Fed now? How many are there? 5, 6, 7? You just said you're uncomfortable with that language. Almost seemed to indicate that you want to tackle bubbles before they get too inflated. Is that part of your role?
You're saying what is the mandate?
How many different roles did the Fed have, and is there any way that you can be a jack of all trades?
I think the Fed has 3 roles, and there's just no getting around it. You got to keep inflation low and stable. You want to stabilize the economy to the best of your ability, and you want this financial stability. So, and I think implicitly those 3 roles have always been there.
But that
They've always been there.
Could be consumer protection, monitoring banks. I mean, you can do all those things. You're very smart. You have a PhD, as we just figured out. But that's a lot.
That doesn't mean anything.
That's a lot of
Indiana, no less.
I mean, for a guy like Ron Paul, who said, I don't know, that there wasn't even a part of the Constitution, creating the Fed. I mean, that's a lot of responsibility for one organization.
Okay, it's a daunting task, but this is what you have to do. What are you going to do? Let financial stability slip through the cracks? I mean, that doesn't work very well. So this is where you have to go.
You made the point that no matter what happens, because the Fed basically controls the printing presses and has the emergency lending facility, that no matter what system you design, the world or the country is going to look to the Fed in a financial crisis.
Yeah, and it's just so true. If you look at the UK, they made a decision to separate off regulatory authority into the FSA, and then they've got the Bank of England sitting over here, and the crisis came, everybody went running to the Bank of England. Why? They've got the money. They've got the money. That's what happens in a crisis. So you've got this lender of last resort role, and there's no getting around that. No matter what you do in the legislation, everyone will run to the central bank. So you have to be ready to handle that.
But back to Joe's point, the consumer protection, having a dual mandate of protecting the nation's monetary policy and making sure that the financial system's in the right place, does it make sense to mix that with consumer protection? Because when we've seen institutions that have had dual mandates like that before, you think of Fannie Mae and Freddie Mac.
Well, I don't know. Maybe the senator can kind of comment on consumer protection. I mean, what I understand the bill is it's an independent entity inside the Fed. I have questions about that, but maybe the senator can talk.
It's kind of an unusual hybrid we have here, which is, what's the old saying, a camel is a horse that was designed by committee. This is a Consumer Protection Bureau housed in the Fed, but for all intents and purposes, they're just renting space there. They have their own budget, their own rule-making authority. But if one of their rules threatens the financial integrity of the system, that can be appealed by the prudential overseer to the Systemic Risk Council that the Fed is a part of. So it's a pretty complicated system.
It's like the sunglass hut at the mall, right? It just sets up and just leases space right there in the lobby.
Something like that.
Jim,
can I just bring up one concern about that? I do not like the importing Fed credibility then on some bureau that we don't have any say over.
They'll have all the responsibility but none of the authority. So
that's exactly problematic. I mean, Senator, do you think that that's something?
Well, the compromise, Becky, was clearly the consumer needed greater protection. Some of that came to light following this crisis. But at the same time, people had concerns about establishing a separate entity that might take on a whole new level of mission creep, so to speak. So this was the compromise. How do you protect the consumer on the one hand without creating an entity that might get outside of its lane on the other? It's one of the things that perhaps has to be debated further as this legislation goes along.
We heard Fed Chairman Greenspan say since he can only control the short end that he really wasn't responsible for what happened in the long end, sort of a continuing defense of that low interest rate policy. But then we've had guys like Bob Barbera in here saying you need to watch credit spreads, and when they get to zero, you need to know that it's not safe keeping things that low. I mean, has the Fed learned? I mean, is that what you're talking about?
I think didn't Chairman Greenspan famously say that history has not treated low-risk spreads very well? I think that turned out to be a very prescient
But it
statement.
happened again, didn't it?
It did.
And it almost took us down all the way.
No, he said that. I thought he said that in 2004-2005 period when. So we were looking at the looking at the low spreads, but. Maybe not enough emphasis on that.
You've got some really important decisions to make with regard to the quantitative easing and how we begin to get back to a more normal situation. What will you look at, Jim? What are the data you will look at to determine whether this recovery has become self-sustaining and we've achieved what they call the escape velocity that will give you the confidence to begin getting back to a more normal situation?
Well, I think we're on track. I do think we're recovering. We'll continue to have positive GDP growth in the first half and throughout the year. We definitely look at jobs, and it's been frustratingly slow, I know. But listen here, I think we'll get some good months of jobs reports coming up very, very soon. We're looking for March to be strong, and I'm hoping that will carry on in the couple of months following that. So I do think we're about to turn the corner on jobs, and we'll be watching that very carefully.
Non-census related jobs?
When you see that jobs report, you want to be sure to separate out how much is census and how much is not. Although the census jobs are jobs, so I mean you can't.
They're real, but most people expect us to create jobs other than government hiring.
Absolutely.
Jim, picking up on the senator's question, what is your preferred way for the Fed to get out? Should the Fed raise rates and keep that $2 trillion balance sheet the same, or should it be selling assets first and then raise rates?
Well, I've been advocating that sort of a LIFO policy, last in, first out. So you brought your rates down to zero, then you substituted quantitative easing for the fact that you couldn't bring rates any lower. Now it seems to me like the natural thing is to withdraw the quantitative easing, and then at some later point raise interest rates. But, you know, I'm a minority on that, but I'm working on it.
But, I mean, this is what's so great about having Senator Bayh on, right? Because Senator Bayh, if the Fed starts selling mortgages and that ends up raising interest rates, there's going to be a lot of political blowback.
Well,
particularly at a time we have a lot of the adjustable rates resetting for on the commercial, on the residential side, and you've got some bills coming due on the commercial real estate side. Not a great time to have rates potentially rising.
This is a story about ordering. The question is, should you raise your traditional short-term rate, which is supposed to have an effect on the whole term structure, or should you sell some mortgage-backed securities in a very slow and easy way in order to get the balance sheet back to normal in a reasonable amount of time? I'd take the second policy versus the first policy. They're both tightening policies, and you wouldn't embark on either until the data tell you that the recovery is strong enough to withstand a little bit higher interest rates.
What about the timing of all that? You guys are doing a lot of stuff to get ready for a party that doesn't have a date yet. When you say, you know, I mean, we're dressing up with raising the discount window, we're dressing up with reverse repos, we've increased the number of counterparties. Is that a this year story? Is it a next year story?
No, I know that it seems that there's been a lot of talk about exit strategy for a long time, but that's because these policies are extraordinary policies. They're really, really off the charts policies that, you know, zero rates, you know, doubled or tripled the, you know, the balance sheet. So you have to be planning ahead about how you're going to get out of here. These things do not happen in a quarter or two. You know, they're going to happen over a period of years.
Talk to Tom Honig. You mentioned him earlier, the president of the Kansas City Fed. He says we should be at 1% now because that is closer to where we're going than zero is.
Well, he makes a powerful argument that, you know, if you come up a little bit, it's still a really, really easy policy, and I have some sympathy for that, but I think it's a little early to go there.
And so would you embark then earlier on a strategy of actually selling assets? Because there's not a lot of support for that on the board from what I can tell.
I think there's more support than you think, and I think you could, you know, you could do it slowly. You could do a little bit at first and then ramp up later. And again, it's all data dependent. So you gotta, for the prerequisite for anything, to do anything, is to see the economy on a firm recovery.
And you expect that?
I do expect that. It's not going to be a roaring recovery, it doesn't look like, but it is going to be a reasonable recovery during 2010 here.
Yeah?
No, that was great.
We'll take reasonable recovery compared to what we've been through.
I just want to know if you have any more questions for your